Good morning, everyone. Thanks very much for joining our webinar this morning. If you are joining from South Africa, good morning. If you're joining from anywhere else in the world, good afternoon and good evening. It's always an enormous pleasure and privilege to have these sessions and to be able to speak to some of our clients and some of our prospects. And we are very fortunate this morning to be having our partners Morningstar and two of their representatives joining us for this CITRINE RSA webinar. Those two ladies are Deborah Slubber. She is a director and also a portfolio specialist at Morningstar Investment Management SA. And we're also joined by Renee Swanepoel. She's a business development manager at Morningstar Investment Management South Africa. Both of these ladies I've had the pleasure and privilege of working with for a long, long time. And they are also both proud CFA or Chartered Financial Analyst holders. I think we've got quite a few people on the session, so if it is okay with everyone, we will begin. It is a live session, so I'm not speaking to a room full of people, so I do not need to tell you where the bathrooms are, but a little bit of housekeeping. Please know that these sessions are recorded, and most importantly, anything that we discuss today is not to be interpreted as or construed as any type of financial advice whatsoever. We are just going to be sharing some thoughts, some ideas, some concerns, and some excitement about markets looking back and markets looking forward. And if you are looking for any sort of financial or wealth planning advice, you are more than welcome to contact your Austin Morrison Associates financial advisor. Good morning, Deborah. Good morning, Renee. Can you both hear me clearly?
Good morning, Stuart.
Good morning. Lovely to have you both. So if you'll give me a second, let me just do a quick intro and then I will bring you in. So let's kick off. First thing I'd like to kick off is something a little strange. It is something called a black swan. So in financial markets, what we normally see is something called a black swan event. I'm sure the slide will come up in a moment regarding black swans. So what is a black swan event? So a black swan event is something that happens globally. It happens every 5 to 8 years historically, and it's normally an event that is a shock. It has widespread implications for not only countries, but normally economies. And it happens, like I said, if history is anything to go by, every 5 to 8 years. Now, what is a black swan as an example? Think about September, think about 9/11, think about the dot-com crash, think about the Gulf War, think about the Eurozone debt crisis, think about the 2008-2009 global financial crisis. All of these events are either economic, socio-economic, geopolitical, whatever it might be. But what they all have in common is they're a shock and they have a massive impact on markets. Now, what normally happens is that when these events take place, markets have an opportunity, if you will, to correct. It normally is the end of a fairly significant bull run for equities. And what happens is everyone takes a breath. There's a lot of resetting, a lot of recalibrating, and then markets sometimes enter into sort of a bull period. There's a nice definition that's just come up. A black swan defined as an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. Black swan events are characterized by their extreme rarity, severe impact, and the widespread insistence that they were obvious in hindsight. Now, some black swan events you could say may have been obvious in hindsight. I would argue that's probably about a 50-50 argument. So why am I telling you about black swan events? It's because of last year and the preceding 4 years. So what we've seen in the last 4 years is no fewer than 4 black swans in 4 years. Now, that is unprecedented. I'll chat to Renee and Deborah and get their thoughts on this in a moment. But if you look at the events that have taken place in the past 4 years, we had COVID, obviously, on the 11th of March 2020. COVID-19 was officially declared a global pandemic. Then on February 24th, 2022, we saw the Ukraine be invaded by Russia. In the last sort of towards the end of 2022 and the beginning of 2023, we've seen inflation skyrocket. And when I say skyrocket, depending on who you are looking at, the US economy, whose inflation went right the way up to 9.1, that's the highest it's been in 40 years. If you look at the UK and the Eurozone, they're experiencing inflation, or have been, that's the highest in 50, 60 years, going back to sometimes the 70s. And then more recently and more tragically, on the 7th of October, we saw an attack by Hamas, the Hamas militant group, into Israel. It was an act of deplorable aggression, and the response from the Israelis has been brutal. Now, today's not going to get political. All I'm trying to illustrate here is the fact that we've had 4 black swan events in 4 years. Now, as you can imagine, as investment professionals, as people who are looking to invest money and ultimately make money for our clients, this type of environment has been extraordinarily challenging, not only from an investment management point of view, but also from a communication to clients point of view. Ordinarily, or sort of fundamentally, we are emotional human beings, and people get very emotional about their money, and so should they. That's why it's so important for people in the investing world, advisors, managers, and so on and so forth, to manage those relationships and to make sure that investors make sort of as many good and right decisions as they possibly can. That's the one point, but perhaps more importantly, avoid making the wrong ones. So before we get into a little bit of an SA focused view, just on 4 global, sort of 4 black swans in 4 years. Deborah, do you want to come in there and have a comment on that? I mean, I'm sure you've never seen this in your career. Do you maybe want to expand on this, and from a Morningstar point of view, sort of how challenging has it been since COVID came?
Thanks so much, Stuart, and thank you so much for having me. And yeah, I guess I do have almost an overwhelming thought when looking at this, and it is one of, that's just the nature of markets. I think sometimes people think in their mind that markets move in a linear fashion and markets will just continue to generate returns year after year. And I think the fact that you are right, that 4 black swan events in 4 years, that is quite a lot to deal with. But when it comes to markets, there's always a lot to deal with. If you rewind back 5 years ago or 10 years ago or 15 years ago, there was also quite a lot of issues, and we're very quick to forget that that's just the nature of markets. There's always going to be volatility. There's always going to be things to worry about. At the end of the day, you need to stay true to your investment principles. You need to do the work, and you need to build portfolios that's going to perform regardless of these type of events. So I think that would just be my 2 cents on what's happened in the last couple of years.
Sure, no problem. And I think let me add a comment to that, and then Renee, if I can bring you in. I think that comment neatly leads into something that a lot of investment professionals focus on, and that is something called recency bias. We tend to attribute a lot more to what's happened in the most recent past as we do to what's happened in the last 10, 15, 20 years. And those memories become a little foggy, whereas what's happened in the last 4 years is rather vivid. Renee, would you agree with that statement?
Absolutely. I think in a market like this, if you've got 4 black swan events in 4 years, what creeps up on you is behavioral biases. So if it's recency bias, if it's hindsight bias, you think we should have seen this coming. Usually it's very easy to see something after the fact. In that moment, it's very difficult to see it. And it's exactly like Deborah said, the market is long-term. It doesn't move in a linear fashion, but it's sometimes okay to see what's going on in the short term. And say things as they are. Markets are tough at the moment, but it's also quite interesting. It's the first prolonged downturn we've experienced since the global financial crisis. So if you think about the length of drawdowns, it has made it particularly difficult.
I think that's an excellent point, is the protracted nature of it, is that COVID did go on and was very real for a long, long time. If we're looking at the conflicts, the 2 conflicts, and again, don't want to get into the political discussion on it, they too look to be quite protracted and going on for a long, long time, and that injects a lot of uncertainty in the market. And as we all know, and for people who don't know, you should know, that is the one thing that markets abhor above all else, is uncertainty. So focusing on that one, let's focus on the bottom left-hand quadrant, because this is quite topical. And I think prior to midway through 2022, everyone will be familiar with the phrase, when China sneezes, the rest of the world gets a cold. I think what we're seeing now is, if I can take China out and say, once the Fed sneezes, everyone gets a cold. And I think that's probably a fair comment. And by Fed, for those who don't know, that's the Federal Reserve in the United States, and they are responsible for setting interest rates. And what that does is it does give the rest of the world some sort of indication as to what the US market is looking at, what it's anticipating, what it's concerned about, and so on and so forth. Now, in June, we saw inflation in the States at 9.1%, highest it's been in 22 years. Since then, we've had several meetings, but they have not increased interest rates since then. And their last meeting of the year is on the 12th and 13th of December. Now, I'm not going to ask you if, actually, I might ask if you think they're going to raise rates. But before I do that, a little caveat, at the most recent Fed minutes, they came out and said inflation was actually coming down slightly quicker than they had anticipated. And then markets lost their minds and everything was up. So let's quickly, before we go on to the next slide, just a very quick comment from both of you. Looking at the December meeting, I mean, and I won't hold you to this, have we reached peak? Are we looking at one more quick 25 basis points before we start 2024? Or can we say, right, let's have a nice cool off, let's have a decent Christmas, and then look forward to the first cut, which may come as early as May last year. Some people are predicting May, which I think is a little bit premature. Some pushing it out into Q3 next year. Renee, your thoughts quickly?
I think, Stuart, like you say, the market is there's always uncertainty. So you can never say with 100% certainty what is going to happen. I think if you look at where the markets are, inflation is moderating, although not as quick as I think they would like, but we still have some upside risks to inflation. So it's also something to consider. On the one hand, you've got upside risks. On the other hand, inflation is moderating, but it's still not where the Fed wants it. But I think if I had to say, hopefully we've seen the peak. I think
sure.
Deborah can jump in here if she's got a different, but I think hopefully to give us some relief, we have seen the peak of interest rates.
Yeah,
Deborah, maybe your comment?
Stuart, it's interesting what you said earlier, and it's exactly right, because the market goes out of its mind when inflation comes in at 1 basis point less than what is expected.
It was exactly that 1 basis point, you're correct.
And it feels like the market just doesn't react based on any fundamentals. It's all very, very sentiment driven at this point in time. And this big question mark is it over? Is the rate hiking cycle over? I mean, all the indications are leading to inflation has come down. And to Renee's point, is that it's still not within the Fed's target. We're looking at inflation above 3% still. Yes, it's a lot lower than 9%, but the Fed's target inflation rate's 2%. Now, if it's ever going to get there, we don't know. And then the shorter term upside risk to inflation is probably twofold. The one is further tension in the Middle East could raise oil prices, and that could lead straight back into inflation. There's actually three things if I think about it now. The other one is if the US dollar stays strong, because if you've got a strong dollar, what does it do? It creates inflation, because everything outside of the US priced in dollars, those prices go up. It's inflationary in nature. And then probably a third thing around inflation is just housing, the housing market. It's still very, very elevated. And the reason being is that you have an effective mortgage rate of around 4%. So what does it mean? It's what people are actually paying on their houses. Whereas the actual mortgage rate is in excess of 8% with a raise in interest rates. Why is the effective rate so much less than the actual rate? It's because people they lock in their house mortgage rate for 30 years. And now that rates have gone up, I'm not going to sell my house and refinance it. That makes no sense. I've locked in a 2% or 3%. So now what it's creating a housing shortage. So it pushes house prices up. The people who can't afford houses go to the rental market. So rental prices go up. So I would say for me, those are probably three up near or closer term risks to inflation, but quite confident that the Fed will start cutting next year. I think the FRA market is pricing in March, as early as March. I think that is a little bit premature, but I think the probability for rate cuts next year is very, very good.
I think I think that's an opinion shared by a lot of economists and analysts. And for those of you that aren't familiar with a little bit of jargon that does creep into these discussions, FRAs are forward rate agreements, which was what Deborah was referencing a moment ago. Deborah, I think that's excellent. What I want to touch on is your second point regarding the dollar. And this actually leads me quite nicely into a chat about SA specifically and EM more broadly. So if we can go on to the next slide. So now let's have a look at SA and some of the concerns that we're looking at, and let's focus on the rand. Okay, so as most people know, the rand is what they call a free float currency. So it basically moves the way the market pushes it. I always say to people, there are two things that never lie in markets. A lot does, but there are two things that never lie in markets. The one thing is bonds, bond yields, and the other one is Forex. Those two moving parts react almost instantaneously to news, to economic data, whatever it might be. So if we focus on, let's focus on EM for race. It's just, Deborah, if I can just stay with you for a second. Emerging markets, historically, both from equities and fixed income, we won't get into the minutiae, but let's look at it sort of from a bird's eye view. Those markets have tended to do better, or do it, relatively speaking, when the dollar is weakening. Okay, those markets have tended to do better. Now, the argument here is that if rates start to come down in the States and we start to see a weaker dollar, comparatively, we see EM currency strength, okay? And that could result in some good news for those types of currencies. So let's use that and focus right on the Rand. So we have seen the Rand sort of oscillate quite violently with regard, anytime there's any news out of the Fed or the US, we see the Rand move quite violently. It's one of the most traded partners or traded currency pairs in the world, the ZAR and the USD, one of. So is the outlook for the Rand, would you say it's fairly positive, based purely on the fact that if we do start to get rate cuts, we could see an improvement in the Rand? Is that sort of a broad view?
Absolutely. I think we would look at it in long-term purchasing power parity. So what that just means is what do you think is a fair value for the Rand? And don't get me wrong, the Rand never really trades at fair value. If it gets to fair value, it stays there for a very short period of time. But it just gives you a sense of the temperament of the Rand at this point in time. And it is incredibly weak. And a lot of it is our own fault, but not all of it. As you alluded to, when the dollar is so strong, when the US economy runs, and when there's risk off, then emerging market currencies tend to suffer and emerging market equities tend to suffer. And we are unfortunately in that bucket and then we've got the added caveat that, as you mentioned, the Rand is one of the most traded currencies, not just within the emerging market complex, but within the world. It's actually the 18th most traded currency, which is remarkable. And that's why it's so volatile. So I 100% agree with you, Stuart, that if we get some sort of risk on environment, the dollar automatically will start to weaken as people spread their wings and they're ready to allocate to risk assets again. And naturally what happens is the Rand starts to strengthen. And hopefully we could see some good news out of the South African economy itself that will also boost the Rand. But we never know. Let's not bank on that. But from a pure global perspective,
Sure.
Absolutely, the Rand is exceptionally cheap at this point in time.
I think that is a shared view. And your final comment there is a really nice segue into my question to Renee. So Renee, you and I have spoken about this many times, but a lot of people on this call may not be that familiar with the dynamic. So I wonder if you wouldn't mind commenting. When people look at the Johannesburg Stock Exchange, okay, and they look at the fortunes of the Johannesburg Stock Exchange, and then we look at really depressing data coming out of the South African economy, whether it's a weak Rand, whether it's weak manufacturing numbers, whatever it might be, those two entities do not move in tandem. And I think that seems anomalous to a lot of people. If the economy is doing well, why isn't the JSE in lockstep? And if the JSE is doing well, why isn't the economy in lockstep? So sort of simplistically speaking, could you just sort of articulate the difference in the difference of the drivers of those two entities? So the SA economy and the Johannesburg Stock Exchange.
Absolutely. So I think if you take the economy and the stock market, it's exactly like you said. They don't always move in the same direction. And sometimes we think the economy is doing badly, the stock market should also. And the big difference is that the economy is backward looking. So if you think about GDP numbers coming out, that is the previous quarter's GDP numbers that gets reported on. If you think about the stock market, it's all about forward looking. So what is the future going to be better than what it is today? And I think if we look at markets, what's very interesting over the last 3 years, and you mentioned this, 4 black swans in the last 4 years. Let's just look at the last 3 years since 2020. Global equities and rands, local equities and local bonds have all outperformed inflation in a very tough environment. Rampant rand weakness, and local equities actually in rands outperforming global equities over the last 3 years. So it just gives you a little bit of a picture of the economy it's been tough on the ground, but the stock market has actually given you some good returns.
In relatively speaking.
Yeah.
And how much? So obviously that's perfect. Thank you. How much of a part does the fact that we have a lot of massive businesses listed on the JSE that are global businesses that don't necessarily depend on a healthy SA consumer to drive the bottom line? If you look at some of the BHP Billiton, for argument's sake, or perhaps Richemont, these are companies that are listed on the JSE, and very little of their earnings are actually declared in rand. So a weaker rand actually amplifies their earnings. How much of a part does that play?
Absolutely, it plays a big part. So if you think about what we call it is rand hedges, so that is essentially companies listed on the JSE but make most of their revenue or earnings offshore. So a big part of that is definitely that gets helped by a weaker rand, those companies making most of their revenue offshore. And if you look into the CITRINE balance portfolio, for example, if you think about, sometimes we think when we're in a local portfolio that it's all local. You've got 34% direct offshore, you've got 22% in the SA component, 22% in rand hedges, and then 16% in pure SA equity. So it's exactly like you say, not everything is dependent on the SA consumer when you in a portfolio locally.
Yeah, and I think that yes, sorry, Deborah, did you want to add?
I just want to add one point to that. Just put a percentage point to the amount of revenue that is generated outside of the borders of South Africa is in excess of 60% of our entire stock market. That revenue is generated outside of South Africa. So it's astonishing.
So more than half. So more than half of the revenue that generates is in a currency other than the rand.
Exactly. So, and that's it comes down to your point of the economy and the stock market is actually so disconnected that you see the JSE generating returns and you wonder, how is that possible if we're not growing and we've got continuous load shedding and that's the beauty of our stock market, is if you look into it a little bit deeper, there's actually a lot more going on than on face value.
All right, so I'm glad you brought up load shedding, because that's going to bring me to, I think, at least three of the tiles you see in front of you, which is the Eskom broken bulb, the corruption, and the truck on fire there. And those are references, obviously, to load shedding, to the July unrest, to social unrest more generally, and to corruption, which was one of the major culprits with our graylisting. Now, I know that the three of us have spoken before. You have enormous you've got an enormous research team globally, and maybe we can touch on the graylisting very quickly. I think a lot of people, particularly in SA, have tried to downplay it, but the fact is, South Africa now belongs to this grey list. And in recent years, we've seen countries like Mauritius, we've seen the Cayman Islands recently come off of that list. So in terms of the view of SA through the grey listing lens, how detrimental has that been? Is it manageable? Is it quite detrimental? Are people just sort of offloading our bonds, our equities? Or is it just a storm we're going to have to weather in the short term? Deborah, I'll start with you.
Stuart, I think it's a bit of both. I think people do downplay it. It is a major thing, and it highlights the risk that there is to things like money laundering and corruption in South Africa. In my view, it's a good thing, because every now and then it's good to have a slap on the wrist and have global investors looking at you and say, this is not right, so you need to be punished for it. So I think the intention from a South African point of view is to fix it. On average, I think the stat is it takes about 18 months to 3 years on average to get off the grey list. It is definitely not the company that we want to keep. We do not want to be, we want to be open to foreign investment. And it does, from an asset management perspective, I can tell you it makes our lives a lot harder, just purely because doing business now with offshore asset managers has become just a lot more onerous. So a lot more compliance, a lot more paperwork. So it sort of delays everything. When it comes to people just giving up and selling our bonds and equities, I think a lot of the foreign selling has actually happened prior to grey listing. I think what we've seen happening this year is more a result of our regulation 28 actually opening up to have more allowance for more offshore equities. I think that was primarily the function for further sell-off. A lot of the foreigners that wanted to leave already left before we were grey listed, because very often what happens is before an actual event happens, you already see the impact before the event. So So that's just my personal opinion, is that a lot of the foreigners already left.
Sure. So I think the overriding, or at least the conclusion you can draw, is that a lot of people anticipated it, expected it, and responded to it. I mean, because those are all not the same thing. I mean, those sort of come in a sequence. Okay, so one last question to Renee, which is the final tile you see in front of you. And I've read a couple of reports, some of which are conflicting, and I always take it with a pinch of salt, depending on who you're reading and who wrote it. So in terms of the immigration statistics, I think it is fair to say that we have seen a rise. We've seen some of those numbers grow. Not necessarily in terms of people actually leaving, but in terms of applications, because I know that process is now sort of backlogged. Some people are blaming COVID. Some people are saying that the government is dragging its feet intentionally. I'm not here to cast aspersions either way, but is that something is that something that happens in the back of your mind? Sort of some wealthy South Africans leaving our shores, or is that something that doesn't really bother you, sort of given the reality that South Africa finds herself in this moment in time?
I think so. It is definitely a risk. So if you look at the risks, there is definitely immigration is one of them. There are wealthy South Africans moving offshore. That puts extra pressure on the fiscus, so tax collection. So I think that's also, it plays into that. But there's also, on the other side, I always think about, if you think about anything in markets or anything in life, you need to invert it. And there's also a lot of foreigners coming into SA. So we always talk about all the South Africans leaving. Some international individuals are actually coming to SA. So I think there's always two sides to any coin, but yes, it is a risk that you need to keep your eye on. I don't think it's not a risk, but yeah.
So just to maybe just close that loop, in your mind, that tile that is showing people in an airport, those are actually foreigners arriving. Am I correct in saying that?
Hopefully.
Am I correct in saying that's exactly what that means? Those foreigners are arriving.
Stuart, I can vouch for foreigners crowding Cape Town like you never before. And it's not just having holidays here,
not just seasonal,
actually coming to work here. They live on the Atlantic seaboard for 6 months or a year, and they work virtually, which you can do now post-COVID. They come and spend their dollars here. It is dirt cheap for them with our rand. You live this amazing lifestyle, and you don't have to pay European prices. And if you actually talk to them, they tell you that, why do we want to be in Europe so close to a war zone with inflation sky high, prices skyrocketing, an issue when it comes to energy supply? You come to South Africa, I mean, you've got enough money to put up solar, you've got enough euros to spend here, and you've got a pretty savvy lifestyle. So there's definitely a lot of foreigners around.
I think that's a very positive note to maybe end on this particular slide. So if you can move to the next slide. So what I wanted to have a chat just very quickly. So when we put this webinar together, the original idea was to chat about our local CITRINE portfolios, which have been in existence for many years now. For a lot of people on this call, they've been invested in CITRINE, be it our balance fund, be it flexible, be it income, whatever it might be. Just to quickly highlight that, CITRINE is a collaboration between Austin Morrison Associates and Morningstar. Morningstar are most certainly the engine room that are putting it together, that are producing some really, really fantastic returns that we've seen. And this session wasn't necessarily about the funds themselves. It was definitely to meet the people behind the decisions. I think that's important so that people can see, put some faces to names and understand how you're looking at the global backdrop, what you're concerned about, what you're perhaps excited about, what worries you about SA, what excites you about SA, and all of those discussions, all of those views, all of those concerns manifest and culminate in the portfolios that we put forward to our clients. So if those portfolios are doing well, which historically they've done exceptionally well, that just lends credence to the quality of what's going on in the background. And I think that is enormously important. So cognizant of time, I see that we've run about 3 minutes over the allotted 30 minutes. I think we only started at 3 past. So we've probably done our session. I believe Kerry Ann is running. Were there any questions? Were there any questions that went into the Q&A, Kerry Ann? I wonder if Carrie Ann is there.
Hi, Stu.
Yes,
I'm
Karen.
just
Any
checking.
questions in the chat?
No, there's
Maybe
no
we've probably got
active
time for one or
questions, but I
two.
think
Okay,
if
that's
you
no
would
problem.
like to put it to everyone who's dialed in, if they would like
Sure.
to pose any questions,
Of course.
now would be
To
the
the
time
website.
under
Okay.
Q&A. Otherwise, we can also, if they pop an email to the email address on the slide showing now, we can obviously return anything that they're looking for.
Fantastic. Okay, brilliant. Sorry, Carrie Ann. Thank you very much. So, Renee, thank you for your time this morning. It was brilliant. Deborah, always a pleasure. And please extend our thanks to the broader team at Morningstar for helping us host this event. It was superb. For those who have attended, thank you very much for taking half an hour out of your diaries to have a listen to myself and the two lovely ladies from Morningstar. If you do have any questions or concerns, first and foremost, have a chat to your Austin Morris financial advisor. If you'd like to pose any questions, you're more than welcome to use the email address, the website on screen, which is ama.webinars@austinmorris.com, and someone will get in touch with you. So, Renee, thank you very much. Deborah, thank you very much. For everyone who joined, thank you very much. I'm sure many of you whom I won't see. So for those who are traveling, please travel safe and have a very happy festive season and a prosperous and joyous new year. Thanks, everyone. Bye.
Thank you so much, Stuart.
Thank you. Bye.
Bye.
Bye.